Don't overlook these 5 critical options when preparing your U.S. individual income tax return. Preparing individual income tax returns in the United States is often viewed as a routine compliance task, yet many taxpayers inadvertently overpay or invite IRS scrutiny by missing nuanced technicalities. Beyond the obvious data entry of wages and interest, several structural components of the tax code remain consistently underutilized or misunderstood. From the compounding benefits of reinvested dividends to the often missed above-the-line adjustments, a thorough preparation requires looking past the standard forms. This assessment explores 5 of the most frequently overlooked aspects of U.S. tax preparation, ranging from investment basis adjustments to the strategic selection of state-level deductions. Number 1. Cost basis adjustments for reinvested dividends. One of the most pervasive hidden errors occurs when investors fail to account for reinvested dividends in their cost basis. When mutual funds or stocks automatically purchase additional shares using dividend income, that income has already been taxed in the year it was received. If a taxpayer sells these assets and only uses the original purchase price as the basis, they are effectively paying taxes on those dividends a second time. Properly adjusting the cost basis upward by the amount of all reinvested dividends ensures that only the true capital appreciation is taxed upon sale. Maintaining a meticulous basis schedule over the life of an investment is essential for preventing this form of double taxation. Number 2. The choice between state income tax and sales tax. Taxpayers who itemize deductions often default to deducting their state and local income taxes, yet the IRS provides an alternative that is frequently more beneficial: the deduction of state and local general sales taxes. This is particularly critical for residents of states with no income tax, such as Florida, Texas, or Washington, where the sales tax deduction is the only way to recover state-level levies on the federal return. Even in income-taxing states, a year marked by a major purchase, such as a vehicle, boat, or home renovation, can see sales tax totals eclipse income tax payments. Strategic filers should always compare both methods using the IRS optional sales tax tables or actual receipts to ensure they are maximizing their state and local tax deduction, currently capped at $10,000 for most filers. Number 3. Out-of-pocket charitable and volunteer expenses. While large cash donations to 501c3 organizations are rarely forgotten, the smaller out-of-pocket costs associated with volunteer work are frequently overlooked. Taxpayers can deduct directly related costs associated with their service, such as the cost of ingredients for a soup kitchen, stamps for a charity fundraiser, or specialized uniforms required for volunteer duties. Furthermore, the IRS allows a standard mileage rate of 14 cents per mile for travel dedicated to charitable purposes, which can add up significantly for regular volunteers. These micro-deductions require disciplined record-keeping throughout the year, as they must be substantiated with receipts or a contemporary log to withstand an audit. Number 4. Overlooked above-the-line adjustments. Many taxpayers focus exclusively on the choice between the standard deduction and itemized deductions, ignoring above-the-line adjustments that reduce adjusted gross income regardless of which deduction is taken. Items such as student loan interest up to $2,500, educator expenses for K-12 teachers, and health savings account contributions made with after-tax dollars are powerful tools for lowering tax liability. Because these adjustments lower adjusted gross income, they can also help taxpayers stay below the phase-out thresholds for other lucrative credits, such as the child tax credit or the saver's credit. Failing to claim these adjustments is a common mistake that directly leads to a higher tax bracket and reduced eligibility for means-tested benefits. Number 5. Prior year carryforwards and unused losses. Tax preparation is often treated as an isolated annual event, but it is actually a continuous cycle where previous year's leftovers can yield current savings. Many filers overlook carryforwards for items like capital losses, which are limited to a $3,000 net deduction against ordinary income per year, with the remainder pushed to future years. Similarly, unused charitable contributions that exceeded the adjusted gross income percentage limits in a high giving year or AMT credits from prior years can often be applied to the current return. Reviewing the carryover worksheet from the previous year's tax software or professional filing is a mandatory step that prevents valuable tax attributes from simply expiring unused. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, investments, and finances. Thank you.